Welcome to the Opening Bell Report.
Welcome back. Today we're looking at an investment analysis on Applied Digital Corp, or APLD. This piece breaks down the stock's 25% surge after a big Q2 earnings beat and a pivot to AI infrastructure.
Right, a really high-octane situation, lots of moving parts. So let's see if the analysis, really holds up.
Let's jump right in. The report's argument seems to really lean on the big revenue beat to justify the bullish case.
It does.
It highlights the massive top-line beat, $126.6 million, versus the $82 million estimate. That's the main driver.
And, the author does a great job capturing the excitement of that headline number. I mean, it's hard to ignore a beat that big.
For sure.
But I wonder if we've really considered the quality of that revenue, its sustainability.
Okay.
The report sort of lumps all the growth together, celebrating this 250% year-over-year increase. But if you look closer and the data is in there, a huge piece of that, $73 million, is from HPC tenant fit-out services for CoreWeave.
Right. And fit-out services, that sounds a lot like a one-time thing. It's construction, it's setup fees, not recurring rent.
Exactly. And that's the core weakness here. The analysis doesn't really distinguish between that one-time spike from construction and the recurring income that validates the whole AI landlord model.
It's comparing apples to construction equipment.
Pretty much. If I build you a house, you pay me once. If I rent it to you, you pay me forever. This report treats those two checks like they're the same thing. And that could be misleading.
I see what you're going for. So how could we strengthen this? The suggestion is, to explicitly split the revenue streams?
Yes, you have to. To improve this, the writer needs to split the setup revenue, the fit-outs, from the landlord revenue, the actual leasing.
To give a truer picture of the business's health?
It gives a truer picture, because right now the report implies this $126 million is the new baseline. But if $73 million of that just vanishes next quarter, anyone expecting that number again is going to be seriously disappointed.
That makes sense. It's about setting the right expectations. So for a concrete example, you could take that $73 million fit-out figure and put it right next to the $12 million in partial lease revenue that's mentioned later in the bull case.
Exactly. And that changes the whole story. Instead of just revenue was up, you're now asking, okay, once the CoreWeave fit-out is done, does revenue fall off a cliff before the real rent starts to ramp up?
That's the million-dollar question for an investor.
It is. It turns the report from a celebration into a real investigation.
And it would actually make the analysis stronger. You could even chart the transition. Show crypto hosting declining, the one-time fit-out revenue spiking, and then the small but growing recurring lease stream.
Perfect. And doing that protects the writer. If revenue drops next quarter, they don't look naive. They look smart because they explain the lumpy nature of the business. It shows you really get the mechanics of being an AI landlord.
You're not just reading the scoreboard, you're watching the game.
Exactly.
Okay, so another theme here is all the excitement around the analyst upgrades. The title of the piece is Why Analysts Just Upgraded to Strong Buy.
Right.
And the report lists the upgrades from Freedom Capital, B. Riley, Needham.
It does, and it frames them almost like endorsements on a book, a victory lap. But I think it misses a huge opportunity to dig into why their price targets are so different.
Good point. It mentions B. Riley has a $53 target.
Which is 51% upside?
While Needham is at $41. That's a $12 gap between two bulls. That's pretty significant.
It's huge. And the weakness here is treating those upgrades as this single vote of confidence. For a smart reader, the gap is where the interesting part is. Why is there a 25% difference in opinion?
So the suggestion is to compare the underlying assumptions to help the investor understand the full range of outcomes.
Exactly. Don't just say they both like it. We need to know why and what they're betting on. For example, drill into B. Riley's thesis. The report says they cite scarcity value of these big campuses.
Okay, but what does that mean in dollar terms?
Right. Explain why that justifies $53. Is it because building new capacity is going to take until 2028? So APLD has huge pricing power right now. Are they the only game in town?
And then you contrast that with Needham's 41. Does Needham see lower margins? Are they more worried about the construction timeline?
Maybe. Or maybe they're pricing in the dilution risk we're about to talk about. By unpacking this consensus friction, you elevate the whole piece. If 92% of analysts say buy, what is that other 8% worried about?
Or in this case, why is B. Riley so much more bullish than Needham?
Yes, It adds a whole other layer of sophistication. It's not just Wall Street loves it, it's Wall Street loves it, but here's where they disagree on how profitable it's going to be.
Which leads us right into the risks. The report has a risks to watch section, which is good. It points out the net loss of 11 cents per share.
And it notes that's an improvement from the 61-cent loss a year ago. It says they're burning cash to build facilities, which is, true.
But is the connection really made between that cash burn and the valuation risk? Or is it just treated like a standalone stat?
That's the thing. The weakness is that it's isolated. It says they lost money, but they are growing, without really digging into the friction between those two things. It doesn't analyze how long their runway is.
Right.
They're burning cash to build this huge campus. And that $126 million in revenue, does that actually cover the capital expenditure? If they're still posting a loss, probably not.
So the real question is, can they afford to become this AI landlord without having to raise more money and dilute the stock?
That's the question. And this is where we can connect it to the insider selling. The report mentions a director, Chuck Hastings, sold $1.8 million in stock.
But it's just a bullet point right now. By the way, a director sold.
Right. But what if we tie the 11-cent loss directly to that sale? Instead of it being separate, what if we ask, is he selling because he knows the capital requirements to finish this campus are going to be heavy?
That's a much darker but necessary way to frame it. Maybe he's anticipating a secondary offering is coming.
Precisely. If they need to raise $200 million more, they might have to issue new shares at a discount. That dilutes everybody. And insider selling right before that could be a massive signal. The report mentions the sale, but it misses the potential signal.
That's a really powerful connection.
And you can compare the cash burn reduction to the timeline. They say the facility hits full capacity in Q3 or Q4. So the question is, will they turn cash flow positive before the money runs out? That's the narrative tension that needs to be in this piece.
Okay, so to make it actionable, the author should integrate the profitability metrics right into the growth story.
Yes, and frame that insider selling as a potential signal about the $30 resistance level. Do insiders think 42 is achievable soon, or do they see 35 as a local top because of cash needs?
If the director thought it was going to 53 like B. Riley, would he really be selling at 30?
Maybe, maybe not, but you have to ask the question.
Let's move to the end of the report, the bottom line section. It offers a technical trade setup.
Yeah.
It says if it holds above $32, the path is open to retest the all-time highs near 42.
Which is, a standard technical take. Support becomes resistance. It's TA 101. But I wonder, what's the so what here for someone who's a fundamental investor?
What do you mean?
Well, the weakness is it gives a technical level $32 without tying it to any of the fundamental catalysts we've been talking about. It feels like the technical analysis was just kind of pasted on at the end.
Instead of flowing from the fundamental story.
Right. Why is 32 important? Why is 42 the target, other than it just being a previous high?
I see. So the suggestion is to marry the technical levels to the fundamental timeline. Create a watch list scenario.
Exactly. For instance, you could link that $42 retest specifically to the next earnings report. The report says revenues should ramp significantly in Q3, so you tell the reader to watch that $32 level around the next earnings date.
That makes it much more actionable. And you could bring in the smart money accumulation you mentioned, Vanguard and BNP Paribas buying shares.
Yes, that's a great point. What if we framed Vanguard's position increase as the reason for the $30 floor? Instead of just, the chart says 30 is support, you say, institutional buying by Vanguard is creating a fundamental floor at $30.
Because charts represent human behavior.
And in this case, the behavior is huge institutions buying up shares. That is much stronger support than a line on a screen.
So for the upside,
instead of just the trade is open, you could say something like, if the stock holds $32 as institutions continue to accumulate, the supply shock from that 100-megawatt scarcity could be the catalyst that drives the move to 42.
That ties everything together. The B. Riley scarcity thesis, the Vanguard buying, the chart level. It becomes one cohesive argument.
And that's the goal. You want the reader to understand how all these moving parts, the fit-outs, the cash burn, the analyst disagreements, interact to create the actual investment opportunity.
So let's recap the main points for our listener. First, on revenue.
Don't just celebrate the headline beat. You have to distinguish between the one-time fit-out money and the recurring lease revenue. The quality of the revenue matters just as much as the quantity.
Second, on the analyst targets.
Don't just list them. Explain the gap. Why does one analyst see 53 and another see 41? The friction between their opinions is where the real insight is.
Third, on the risks.
You have to connect the cash burn to the stock's valuation. Use the insider selling as a clue. Don't just treat the net loss as an isolated fact.
And finally, the technicals.
Marry the chart to the fundamental story. Use institutional buying to explain support levels, and use the construction timeline to justify the price targets. Make the chart actually tell the business's story.
This has been really productive. I think the source material here is great. It has all the right data points. The opportunity is just in weaving them into a more critical argument.
Absolutely. The writer has done the research. Now it's about connecting those dots to help an investor see what's coming next, not just what happened yesterday.
So to the listener who submitted this, you have a really great foundation. The factual density is excellent. We invite you to take these lenses, revenue quality, analyst divergence, risk correlation, and revise the report.
We'd love to see the next draft. It's always great to see a piece evolve from just a report into a real thesis.
Don't forget to like, share, and subscribe for more.